Good everybody. Thank you very much. I believe you enjoyed our last class. All right, so let's move forward. Okay, so now we're going to be talking about the language of the market, Forex market. All right, and I want to also shock everybody in this room. I want all of you guys to understand something. Before you become a doctor, you need to understand the language of medicine. All right. Before you become an astrologer, you need to understand the language of astronomy. Before you become a pastor, you need to understand the language of the tongues. All right. So now, before you become a forex trader, you need to understand the language of forex. The major reason why many people are not successful in this business is because they don't understand the language of the business. Okay. So now, who can guess? Who can guess what is the language of the financial market? And let me even help you guys. It's not English, so nobody should say English. What is the language of the financial market? Who can tell me? All right. Candlesticks. Are you sure? Are you sure? All right. How about you, sir?
Price.
Price. Okay. You want to say something? Why did you go with candlesticks? All right. So let's move forward. The people that said candlesticks is the language of the market are right. So let's put our hands together for them. And you're not entirely wrong, actually, because price also is what forms candlestick. All right. So let's move forward. Please. Yeah. So candlesticks. What are candlesticks? What do they do? What do they represent? How are they important when it comes to the financial market? This is how they're important. Candlesticks depict or reflect the state of battle between the bulls and the bears of any market at a given period of time. Okay? So candlestick depicts or reflects the state of battle, that's the current state of battle between the bulls and the bears of any market over a given period of time. What that simply means, or for those of you that don't understand what bulls and bears actually means, it's very, very simple. When we say bull, when something is bullish, we're also talking about upward. All right? When we say something is bearish, we're talking about downward. And in Forex, one thing I like about Forex is that everything is symbolic. Have you ever seen a bull fight before? Bulls, they fight by going down. They take their head down, all right, and up. Okay? And then, have you ever seen a bear fight? A bear fight by going up and hitting down. All right, so it's very, very symbolic. When we say it is a battle between the bulls and the bears, we're simply saying we're talking about up and down movement in the financial market, because the market can only go in two directions. I don't know if anybody knows the third direction. There cannot be a third direction. Okay, is it that the market is going up, is that the market is going down? So now, candlestick depicts or reflects the state. That's the current state. It speaks to you. It tells you about what is happening. So candlesticks are born like reporters, like CNN reporters, when they are fighting war in Iraq. They go to Iraq and they are telling you, okay, currently the American soldiers are running eastwards of the latitude of whatever. I don't know if you understand. So is the candlesticks in the financial market. All right? So is the candlesticks in the financial market. So let's move forward basically. So as I explained, let me just make that into something visible. Okay? The bulls. All right? Then we have the bears. Okay? Another name for the bull is it's up. Another name for the bears, when they say something is moving bearish, they're simply saying that the market is going down. Okay? All right? So we have the bulls and the bears. Okay? So now, why do you need to understand, before we move any further, why do you need to understand candlesticks? Why are they important? Okay? Why are they the most important thing in the financial market? Okay, who can answer that question? Who can answer why the candlesticks are the most important thing in the financial market? Nobody.
It's the price action.
Okay.
And it tells you about the direction of the market.
Okay. Okay, that is good. Can we clap our hands together for him? Can we jam our hands together for him? All right, so see. The candlesticks aids us to know when the market is about to stop and reverse, or when the market is going to continue, all right, in a particular direction. Candlesticks are important indicators that enables us to know when a particular market wants to turn, wants to reverse, or a particular market wants to continue. Say, for example, you are in a position and you are going long, all right? You are bullish on a position, all right? You are bullish. That means you are saying the market is going up, all right? You bought. Another name for bull is, another name for a bullish scenario is that you are in a buying scenario, okay? Another name here is that you are in a selling scenario, okay? So, take for example now, you bought euro US dollars, and you are expecting that the market will go up, and then you see a candlestick formation that depicts reversal. What do you think you will do? You're already on profit. Let's say you're already on profit of $100. What do you think you will do? You close your position. Because one thing that is never stable anywhere in the world is change is constant, all right? It is never stable. Nothing remains the same forever, okay? So when you are making money, the trade has gone your way, 100 pips, you have made $1,000, okay? And then you see a bullish reversal formation. Only thing you need to do, the market is trying to speak to you. Come out of this trade. Come out of this trade. But some people want to hold on to those losing data position because they say, okay, because of greed. They say, okay, let me hold on. $1 more. Because of $1 more, you end up on a minus. That is how Forex work. Okay? So, the major things as Forex trader we need to avoid is greed. The most important thing we need to avoid as Forex trader is greed. Forex trader is not supposed to be greedy. All right? You have to follow your strategy to the letter. All right? And then you have to recognize candlestick formation. So you know when a particular strategy or when a particular trade has stayed too long, or when a particular trade is about to continue. There are sometimes you may see scenarios where you are on a long, that means you are on a buy position. You are basically forecasting that the market is going to go up, and the market is already up. All right? And then you see bullish, that's bearish candle. When I say bearish candle, that means you see candles on the other, that's of the other direction. Some people may get scared and say, oh, let me cut. But you need to recognize the pattern that is forming, whether it's a continuation pattern or a reversal pattern. So you see, candlestick can open your eyes to whether you need to stay in a position or get out of the position. All right, let's move forward. So now let me just tell you a little secret. This is my secret, okay? This is my secret. The smaller the wick of a candlestick, the less volatile price was during the time frame. Okay? The smaller the wick of a particular candlestick, the less volatile price was during that time. Okay? This is my secret. Some people, not everybody likes GBP USD. Why? Because the GBP USD is very, very volatile. Okay? The GBP USD is equals to volatility. Okay? It is very, very volatile. It forms a lot of, when I say volatile, there's lots of movement in that particular market. And if you go and check a chart of the GBP USD, you will see wicks. So the smaller the wicks of a candlestick, the lesser the price volatility during that time period. So if you are looking for markets and you are not someone that likes volatility, look for candlesticks pattern, or look for a market that has smaller wicks. Then you know the prices are fairly stable. You can trade that particular market. You can catch an easy 50 pips without the market reversing 150 pips. Right? Yes. So thank you very much. So let's move forward. Basically, what are bearish candles? We have been talking about bulls. We have been talking about bears. So what exactly are bearish candles? A bearish candle, when I say bearish, okay, a bearish candle indicates that the bears controlled a particular market for a given period of time. You know, in Forex, we have different time frames. We have the 1 hour, we have the 1 minute, we have the 4 hours, we have the 3 hours, and all of that. So if, for example, now you set your chart to 4 hours, and then you see a bearish candle, what that is indicating is very, very simple. Is that the bears, all right, the sellers, all right, are actually controlling the market for that given period of time. Okay, so that is what we actually mean by bearish candle. So another thing about the bearish candle, let's talk about the bearish candle basically. So we have bearish. So for those people that don't understand what bearish is, I will still add, I could use sell. All right, sell candle, bearish slash sell candle. All right, what are bearish candles? All right, these are the basic characteristics of bearish candles. All bearish candles are formed in this exact manner. They have an open, which is above. Let's say this is a bearish candle. They have an open, which is above, and then they have a close, which is below. Then they have maybe a wick. This is exactly how a bearish candle is formed. All right. When you see a bearish candle, when they say something is going down, okay, when they say something is going down, it means it was somewhere that was higher, obviously, right? If they say something is going up, it means it was somewhere that was lower. So when we say bearish candle, it started up, but it ended down. All right, so that's why we call it a bearish candle, or we can call it a sell candle, or we can call it a down candle. All right, so now let me calibrate this a little bit. We have 1, 2, 3, 4, 5, 6, 7, 8, 9. All right. So now, looking at this calibration, I want to explain what you are seeing here. Okay, we have this. They call it H, highest high. And here we have lowest low. This is the high and this is the low. Okay, so now the market opened at 3. If I'm to trace this out, the market opened at 3, but after opening at 3, it went a little bit upward. That's why we call wicks shadows. They are not real body. All right, this is the real body of the candle. This is what is important. This is what determines if the candle is bearish or if the candle is bullish. All right, if according to some brokers, if this is red, you know it's bearish. If it's blue, you know it's bullish. Okay, so now the market opened at 3. It went as much as 2. Okay, but was not sustained at that period of that time interval. It was not sustained. It now went down and closed at 8. It closed at 8. But before closing at 8, it went as low as 9. That is what this market is trying to tell you. That's what this candle is trying to indicate. It is telling you how price reacts to time. All right? How price is reacting to a given time frame. What are the scenarios? What are those things that happened within a given time frame? Market opened at 3. It went as much as 2, but was not sustained within 1 hour. It now came down to 8, but before closing at 8, it has gone as low as 9. All right, so it's indicating what happened over a given price. So let me just say candlesticks. Let me just add candlesticks indicates what exactly was price over a given time frame. All right, so candlesticks basically indicate what exactly was price movement over a given time frame. Looking at this bearish candle, it moved to 2, all right, was not sustained, came down to as low as 8 and closing 8, but before closing at 8, it came as low as 9. So that's why we have a shadow under here. So let's move to a bullish candle.
That's the question.
Okay, sure.
What could be the reason for that shadow movement, either upward or downward?
It's price action. Price can move anywhere they want to move. Price are like liquid. That's why we say the market is liquid. The market can go up today, in the next minute. Check your charts again. It's going down. All right.
As a result of
Demand and supply.
okay, if it's the bearish candle, is it as a result of the bullish activity? You know, pushing
Market downward. No, the bulls don't push the market downward. It's the bears.
upward.
Yeah. So basically, if you see a bearish candle, as I said earlier, it indicates that the bears, all right, the sellers, they had the upper hand during that particular period of time. All right. So that's what a bearish candle indicates, basically. So let's just move forward. Let's move forward. Let's talk about the bullish candles. All right. Right, bullish candles. This is the major characteristic of a bullish candle. This is what makes it bullish. All right, it started from down and ended up. So it opened here. We have a close here. Then we have high. We have low. All right. Following, right? And the color for some brokers is usually blue. Some brokers can allow you to change the color to anything you want. You could change it to white, you could change it to green, you could change it to blue. So, but basically, all the bullish candle is just indicating is that price started lower and closed upper, signifying that market wants to go up. All right, market wants to go up. So, let's calibrate this. We have 1, 2, 3, 4, 5, 6, 7, 8. Then we have maybe 0. Okay. So now let's use our calibration. The market opened at 1. Okay, but after opening at 1, it went as low as 0. Okay, it went as low as 0, and then it was not sustained. It went up and later closed at 6. Remember, market opened at 1, went as low as 0, closed at 8 at 6, but reached 7. So looking at this candle, you can basically know when market opened. Say, okay, market opened at the price of when the price was 1, went to as low as 0, but it was not sustained, but closed above 1. So what I just want you to understand about this is that in a bullish candle, before a bullish candle forms, there must be price opening below, and then there must be price closing above. Okay, when we are talking about bullish candle, we are also talking about up. What should come to mind is upward movement. All right, up. Okay, bullish, up, and all of that. So price started at a place which was low, and then let me make an illustration to portray that. We see before they say something went up, that means it started somewhere lower, right? So it is not just, it started from somewhere that was lower and it is up. So we call it up candle. We call it bullish candle. All right. So that is that. Let's move forward. Let's move forward. Price action. Okay, but before we go to price action, let me just tell you how candlesticks are formed. All right. How candlesticks are formed. Candlesticks are basically formed by combining different candles. Okay, two candlesticks, two 30-minute candlesticks equals to one 1-hour candle. All right, two 30-minute candle equals to one 1-hour candle. Let's say our time frame is 1 hour. All right, our time frame. Let's just make an example. Our time frame is equals to 1 hour, and then we have in our time frame that is 1 hour, we have something like this. Okay, we had something like this. Who can tell me what this is? All right, that's good. Clap on for yourself. That's the hammer. All right, on a 1 hour time frame. Okay, 1 HR. Okay, so 1 hour candles are basically comprised of two 30-minute candles. All right, so these are the two 30-minute candles. We have a bearish candle let me indicate, okay, let me just write it. Bearish, okay? And then we have a bullish, we say plus. Bullish, okay? So a bearish candle forming this week, indicating that market went down, okay, but was not sustained, but closed up. So a bearish candle looking like this and a bullish candle forms a hammer. And you know, we basically know what hammers are. They basically indicate that they are reversal candlestick patterns. All right, when you see a hammer in a zone, that's a support or resistance zone, basically on the support zone, you know that the market wants to reverse. Okay, the market wants to reverse. Going further, I'm going to talk about support and resistance, what they indicate, what they are, and all of that. So let's just talk about price action. Price action. All right, price action. How does something react? What are the characteristics of price? Okay, when we talk about price action, what should come to your mind is price. What are price? What are its characteristics? How do they act? Okay, price action is basically the act of using past historical data to determine the future. Talking about a weather forecaster, all right, he uses past historical data to determine the future. So when we are doing price action, we don't know the future, all right, but we use past information to determine with about 70% accuracy what is going to be the outcome of the future. Like if you look at one of our market analysis video, CAT CHF to be precise, I said exactly where price was going to turn. How do I know? I'm not God. It was due to price action. Okay, I knew that was a resistance zone, and market could not possibly break that zone due to one or two fundamentals. And then the market went to that zone and fell. So I was able to use what I could see to know what I could not see. All right, that's what price action is all about. Okay, so it entails the study of price reaction to support and resistance. How does price react to support and resistance? So let's basically talk about support and resistance. Okay, we now understand what price actions are, right? Now let's talk about support and resistance. Support and resistance. Okay, support and resistance. Okay, let's talk about support first of all. A support, or another name for support, is demand zone. It's like flow and all of that. Demand zone, flow. All right. These are other names for a support zone, and they are not just called demand zone for no reason. They are not just called floor for no reason. Okay, let me explain why they are called demand zones and why they are called floor. Let's start with why they are called demand zone. Okay, I told you earlier that demand is what causes price to move upward. Okay, demand is what causes us to increase price. For example, now the person that produced this water, okay, produces water and say, okay, the price of this water is 100 naira, and after producing 100 bottles of this particular Lasien water, okay, and nobody buys it, what do you think he's going to do? He's going to reduce the price to 80 naira. And see, if people buy it at 80 naira, say, okay, that's my price. He leaves it at 80 naira. Okay, so demand is what influences price, all right, to the upward direction. So if there's high demand for this water when it's at 100 naira, what the owner of this company would do is that he increase the price. If it was 100 naira, he adds 10 naira to see what is going to happen. All right. If it was 110 naira, he adds another 10 naira just to know the stable price. Okay, price is never stable. Price is always moving up and always coming down. All right, based on demand and another factor called supply. Remember when we talk about what moves the market, we talked about demand and supply. Now we want to look at demand zones and supply zones. All right, Let's look at demand zones and supply zones. When we say demand zones, these are zones or support or floor. These are zones in the forex market that acts as, when we say support or demand zone, these are zones that act as a floor. Take for example now, let's say this is a surface, okay? And then we throw this pen. Why was this pen not able to go further downward? Was because this acted as a floor, all right? This acted as a support, all right? This acted as a demand. And how does it act? It acts by impeding further downward movement, okay? The price could not move further than, let's take this as price, all right? Let's say this pen is the candles or is price, and it was going downward. But once it gets to this zone, all right, it turns, it reverses, all right, and start going up. This is where you should be looking for reversal candlestick pattern, right, at the supply zone. That's for we should be looking for bullish reversal candlestick pattern, because we're expecting that when price get to a demand zone, demand increases, and then what happens? Price goes up. Because when the demand for a particular commodity increases, what the action is that the price of that commodity goes up. Okay, so let's illustrate that. This is a supply zone, otherwise called support or floor. All right, price is coming. Once it hits this zone, it reverses and goes up. All right, price action. Price, how does price react to various points in the market? How does the market react to various prices? Let's calibrate this. We have 1, 2, 3, 4, 5, 6, 7. 7, let's say 7 is it's support and resistance. Let me just say one thing also. These zones are not basically a straight line. Most people confuse them to be a straight line. They're not a straight line. They are ranges, all right? They are like, okay, let's say 7, 8, 9 is the support or demand zone or whatever. Okay, so we have our support zone, and it's at 7 to 9. Okay, whenever markets come along this zone, it acts by reversing. All right, it doesn't pass this zone. It tries to break the zone, and then most times 80% of the time it reverses. All right, it reverses and goes the other direction, because at these zones, another name for this zone that I've not told you guys is buyer's area. Buyer's area. Okay, why are they called buyer's area? It's because these are where buyers are waiting to buy. These are where fellow traders like you have put buy orders. All right, so the market can only sell as much as this. So whenever it gets to this zone, let's say the zone of 7 to 9, it starts trying, the market starts consolidating. Basically, it starts acting, trying to, you see price action starts getting tough. The market starts pausing, basically. Okay, it starts giving you a pause. Market that was moving at 100 degrees, when it got to this zone, it paused, telling you that there's something about this zone. All right, telling you that there's something of importance around this zone. That's the zone from 7 to 9. That's why then we should now start looking for bullish reversal patterns, so we can enter for a buy along this zone. And when we enter for a buy, 70% of the time we'll be right. All right, so because demand increase at this zone, buyers are waiting for the market to get to this zone so that they can push the market upward. That's by buying, by demanding. And I tell you, the whole of this is price. The whole of this is price. Okay, the whole of this is price. So when the market gets to this zone, buyers are buying, they are increasing demand so that the market will reverse and start going up. But remember, before this time, sellers were taking control of the market. But as soon as the market got to this area, it paused. You see price action getting tough along this area. Candlesticks pattern, reversal. We'll talk about reversal candlestick pattern. We talked about candlestick reversal pattern in the videos. Okay? And basically, you saw how reversal, we talked about the various reversal candlestick pattern, all right, that we have in the forex market. You saw how they will be forming along this zone. That's bullish reversal candlestick pattern, and then they will move up. Basically, that's how so you are supposed to enter around here. I usually talk about V bounce. Okay, or we move further, I'm going to explain what a V bounce means. That means that's basically when price is moving. Let me just make another illustration. Price is moving moving impulsively to a particular area, but before getting to that area, you see price pauses. It starts to pause. All right. Once it gets to that area, and you see a V bounce, that's a small reversal. You are supposed to enter for long here, and 70% of the time you see the market will go long. Okay, so have you noticed the V? This is what I'm talking about. This is our V bounce. Okay, that's our V bounce. So the market getting to this zone, this zone between 7 to 9, it paused. It started showing bullish reversal patterns, and eventually it turned. All right. So that's why I talked about candlesticks being the language of the market. That's how candlesticks can communicate to a particular trader about where exactly should you be looking for up opportunities or long opportunities. Where exactly should you be looking for short opportunities. Remember, when we talk about long, we're talking of up, all right? We're talking of bullish, all right? When we talk about short, we're talking of bearish, all right? We're talking about down, all right, and all of that. So let's talk about resistance. We have talked a lot about support, right? Resistance is just the opposite of support, all right? They're the opposite of support. Remember, the support is acting as a floor. Resistance will be acting as a roof. Resistance. Let's talk about resistance. What are resistance? Other names for resistance are roof. Yeah, ceiling. Basically the same thing. Ceiling. Okay. And who can help us? Sky. Barrier, whatever. So we can say they are resistant, they are roof, they are ceiling, and they are also supply zones. Okay. Supply zones. So they're always upward. It's a region above the market where price reaching that region cannot continue on that cannot move further up. All right. As I said, with the bearish that's the support. They are also a zone. They are not a straight line. They are not a point. Many people believe they are just one straight line. No, they are not. They are a region. All right. So let's have a little explanation to back up that. We have 1, 2, 3, 4, 5, 6, 7. Price started at 7, went up, got into this region, could not survive the bearish. We can also call this. Let me add something. We can also call this sellers area. All right. Why is it called sellers area? Because there are lots of sellers here, waiting to push the market down. All right. There are sell limits. People have already determined that between 1 to 3 is a supply. Yes, it's a supply zone. So they have placed sell limit order so that when the market gets to this point, it cannot further go up. Rather, it reverses. All right. Remember the law of demand and supply for those people that are economics. All right. It basically states that when the supply of a particular commodity gets too much, all right, when there's a lot of supply of a particular commodity, the price reacts by going downward. All right. When I usually love to say this, why water is this cheap in Nigeria, all right, is because we have water in abundance. All right, we have water in abundance. But if you go to the sub-Saharan desert, you go to countries like Niger, sorry to say, the price of water will be like, we can buy water here for 100 naira. All right, but the price of water in Niger can be like 10 times that. Why? Because the supply of water is minimal. All right. So when the market gets to where there's abundance of supply, what do you think happens to price? Price falls. So what should you in the first place be looking for in this region so that you can take advantage of the sell opportunity that is about to form? What should you be looking for? Who can answer that question? When the market gets to this zone, what should you be looking for? Good. You should be looking for bearish reversal patterns. All right. should be looking for something like Green Star Doji. All of them. Look for them, and those the ones we discussed earlier classes. All right. This is exactly the zone between 1 to 3. Is exactly where you should be looking for all those reversal, all those bearish reversal patterns. Okay. So another thing you should be looking for is the V bounce, or should I call it the N bounce? Okay. The other one we had the V bounce. Now we should be looking for an N bounce. So this is what I mean. Okay. So the market gets into this place. Take note. The market gets into the zone between 1, 2, 3. Okay. The market gets into the zone between. It starts to pause. All right. It starts to pause. All right. And could not survive the zone. The momentum he was using to go up. We call this an impulsive move. All right. Impulsive move to the upside. An impulsive move to the upside. The market begins to pause, telling you that there is relevance in this area. There is something about this area. All right. And eventually you see an end bounce. All right. So after you have gotten an end bounce, you are supposed to enter here. And you put your stop loss here. For those of us that use stop loss, those of us that don't use stop loss, you put your hedge. Your hedge here. / stop loss. All right. You put your hedge here / stop loss. Okay.
What about people that actually placed a sell limit?
Okay.
Why would you place a sell limit when you have not seen reversal patterns?
Okay. That's people that place sell limit here. Yeah. It's because they have seen that's price action. Now remember we are talking about price action. And what is price action? The act that's the act of using the past historical data to determine the future. Before ever, let me tell you, before ever you take an action or look for any end bounce or look for any reversal pattern, that's bearish reversal pattern in this area, this pattern must prove itself to be relevant. How does this area, the area between 1 to 3, prove itself to be relevant? It's by price action. Let me explain. Now see, we have this area to be a potential, now listen to what I'm saying, potential reversal or potential resistance zone. And we have it at 1, 2, 3. We have it 4, 5, 6, 7, 8, 9. Okay, it's potential because it has not proven itself. All right, it has not proven itself to be a resistance zone. We are guessing. We say, okay, we don't know. Nobody knows. So now, price comes the first time. And what is price action? It came down. Price came the second time. And came down. It's only a fool, all right, that is not going to know that there is something relevant about this area. First time price came here, it could not survive. It came down. Price is coming here the second time. It came down. So when it comes here the third time, whether the devil likes it or not, 80% of the time, it's going to turn and go the opposite direction. So what you should be looking for when the price gets to this area is bearish reversal candlestick pattern and, according to us, end bounce. So you enter here, put your stop loss here or your hedge, and then you hope to see the market move downward. 70 to 80% of the time, the market is going to do that. So let me just give an instant to buttress my point on that. All right, you have this table in your house, or you have this shirt. That's happened to me before. My favorite shirt was actually the shirt I hated the most when my mom bought it. All right, I hated the shirt the most when my mom bought it. Why? Because I just said they should give it to another person. They should give it to my junior one. Actually, that I don't actually like it. But I wore it the first day, and my best friend was like, "Oh boy, Tony, boy, you don't finish work today." You understand? There were lots of praises. There were lots of comments. When I got home that day, I went to the mirror and looked at myself again. I said, "Well, I think I'm beginning to like this shirt." All right, because I think, okay, that was the first time. I did not even think about that. It happened the second time. It happened the fourth time. I went to the mirror and looked at myself, and I was like, I think I'm beginning to like this shirt. And that shirt became my most favorite shirt in the whole world. I almost killed the dry cleaner that spoiled it for me. I still wear it anyway because it's my favorite shirt. But prior before it becoming my favorite shirt, he had to prove to me that it suits me, okay? He had to prove to me that I loved it, but I did not know yet. Alright? Just as how you did not know that this zone was a resistance zone until the market had to prove to you by price action that this zone is a reversal zone. Alright? So you don't know. You don't know the end from the beginning. You are not God. Okay? But whenever the market gets here, you work with what you see. That's why we say price action is determining the future by the past. You work with what you can see to determine what price is going to do. And 80% of the time, 70% of the time, the market does that. So that's how we have our zones. Okay? So now let's talk about trends. Let's talk about trends. Let's talk about trends. Let's talk about trends. We'll take notes, please. For those that have your notes, a market, okay, the market is said to be in trend, all right, when the market make successive lows and highs, okay, or when the market moves in a certain direction. When the market moves in a certain direction, the market is said to be trendy. If the market is not moving in a certain direction, that market is not trendy. All right. So a trend is a trend when the market is following a particular direction. It can be upward, it can be downward. All right. So that's what the trend is. So now, there are two kinds of trend in the forex market. Only two kinds of trend. We have an uptrend, or we could say, different names we have for up in the forex market. We could call it bullish, we could call it long, we could call it anything, even though you have to call it in your language. How do we say up in your various languages? You could call it that, all right? That's what an uptrend. When we say up, something is moving up, basically. All right, so we have a downtrend. Those are the two trends that we have in the forex market. Either the market is moving up, all right, or the market, this is uptrend. And then we have a downtrend, all right, downtrend. Okay, but I want to tell you something about the forex market. Don't expect to see a trend like this. Never in your life expect to see a trend like this. It wouldn't happen, right? Because that's when we talked about market anatomy. This is not how the market moves. The forex market moves by going, when it wants to go forward. For example, let's say this is my destination, all right? Where the television is my destination, and I'm the forex market. I will move to a certain point, to a certain price, and I'll move backward a little bit. I'll move to another point. I'll move backward a little bit. He likes testing us. He likes joking with us, all right? He will go to your stop loss. Sorry, he will go to your take profit like this. And don't. I laugh. I don't even understand. But the market is making a trend. Because you can't tell me I'm not moving forward, but I'm actually moving forward. The fact that I'm moving forward and coming back doesn't undermine the fact that I'm not moving forward, all right? I'm moving forward. I'm taking more moves to the front than I'm moving backward. So I move to 1, 2, 3. I move back one step. I move to 3, 4, 5. I move back one step. That is how the forex market works. It doesn't move. We don't have this kind of perfect trend. This is what we have. If the market wants to move up, it does this. Impulsive move. Consolidation. Impulsive move. Consolidation. Impulsive move. Consolidation. Impulsive move. So, but isn't this market moving upward? It is. All right. So what kills most people in the financial market, what kills most forex traders is that they say the market is moving upward, right? And this is where they will enter. As soon as they enter, the market wants to make a pullback, all right? Wants to take a pullback and it hits their stop loss. They will say forex is a scam. Forex doesn't work. people don't make money in forex, right? See, I told you, first of all, you will not see this kind of thing in forex. It doesn't exist. All right. If this was forex would have been the easiest, would have been the safe haven for every lazy person. Anybody that does not have what to do will be trading forex. All right, basically. But this is forex, and it is not easy, but it is possible. It is not easy, it is possible. All right. So, trying to demystify forex for you, we have this. All right, and we have, first of all, an impulsive move. An impulsive move is a move in the real direction of the trend. So we have impulsive move. So we can say a trend is made up of impulsive moves and pullback. All right, this is the pullback. So we have an impulsive move to the up, impulsive move to the upside, then we have a pullback to the downside. What kills many people is that while the market is going up, all right, the big boys are pushing the market up and laughing at you. You want to follow the big boys, you want to do something that is bigger than you. You enter, you are happy. This market is going up. If this market does not go up, let me die. Don't you understand? And immediately the market turns against you and hit your stop loss. All right, you won't die. You won't die. You will cry. All right, you start telling people how forex is a scam. How forex has frustrated your life, how forex made you not to go to university, how forex want to make you to commit suicide. You don't know that's how the market moves. All right, the fact that there's, okay, just look at two people walking, for example. Someone is walking upright, is walking straight, another person is walking as if one of his legs is not good. All right, the fact that the person is walking as if his leg is not good, that's his characteristics, that's the way he walks. This is the way the forex market moves. You can't change it. Just like a drunkard, for example. You can't change how a drunkard acts. All right? Basically. So we have an impulsive move. We have a pullback. You can't make forex to work like this. It's not possible. All right? It works like this. So now, where do we enter in a particular... where exactly are we supposed to be entering? I'm going to show you that. That's when we come to trend line. All right, but let's talk about uptrend and downtrend. So now, market moved impulsively, pulled back, moved impulsively, pulled back, moved impulsively, and all of that. It's making a trend. It's moving upward. So this is an uptrend. Let's talk about a downtrend quickly. Let's talk about a downtrend. Let's talk about a downtrend. Okay, a downtrend. The downtrend is a trend to the downside, and it's not perfect. So it's something like this. All right, something like this. Okay, something like that. That's a downtrend. The market is moving downward. All right. So now, why is it a downtrend? Let's go back to why this one is an uptrend. The fact it is moving upward is not only what makes it an uptrend. The fact that this is moving downward is not only what makes it a downtrend. There are other characteristics. All right. So let's talk about downtrends. All right. A downtrend is called a downtrend because the market makes series of what is called higher. Sorry, let's talk about the uptrend first of all. An uptrend is called an uptrend because the market makes series of higher highs. That's, we have a high. Sorry, we have a high, and then we have a higher high, and then we have another higher high. All right, and a higher high. The market is moving upward. It's making levels of highs. All right, levels of highs, and then it's making what is called higher lows. We have a low. Initially, we have a low, and it makes a higher low, HL, and what do you expect? HL. Okay, so why do we say a particular market is in an uptrend? It's not because the market, not just entirely because the market is going up. All right, it's because the market is making series of, this is a high, this is a low. First one. So before we ever say the market has gone into a trend, we need to see this. All right, we need to see first an impulsive move to a particular direction. we need to see a pullback. All right. This does not indicate if the market has gone into another trend or wants to reverse or anything. When we see this, we suspect that the market is now trying to go bullish. But when we see something like this, we just conclude the market has changed trend. Maybe prior before this, the market was going down. All right. Prior before this, the market was going down. And then we see an impulsive move to the opposite direction. The market pulls back. Another impulsive move to the upward direction that breaks the high. All market has highs and lows. All right. All market has highs and lows. Okay. They all have highs and lows. If you want to say, let me demystify this. For example, we have a downward market. Even a downward market has highs and it has lows. It has highs and it has lows. All market has highs and lows. This is an upward market. All right. And it also has highs and it has lows. It has highs and lows. All right. All market has highs and lows. But what makes this market different from this market? Very, very simple. While this one has a high and has a low, this high is not an ordinary high. It is a lower high. All right. This low is not an ordinary low. It's a lower low. Why is it a lower low? Because it's lower than this low. Why is this a lower high? Because it's lower. It's a high. Quite all right. Nobody's arguing that. But it's lower than this high. So it's called a lower high. So we have lower high. Then we have a lower low. This is a low. And so is all of this. All right. But what makes this low? Okay, what makes this low a lower high? Is because it is higher than this. So we have, a higher low. HL. All right. What makes this low different from all these lows is that it is higher than the previous low. So therefore, it is a higher low. What makes this high not an ordinary high is because it is higher than the previous high. Therefore, it is a HH, higher high. But all markets have highs, all markets have lows at the end of the day. Okay? So we have a high, we have a low. We have a high, we have a low. We have a high, we have a low. All markets have highs, all markets have lows. But the difference is what makes us to understand trend. When markets are making sets of higher highs, we say the market is an uptrend. And also, when the market are making sets of higher lows, we say the market is in an uptrend. Therefore, if the market is making sets of lower highs, LH, let's say this is a high, this is a low. We have an LH, we have a LL. So when the market is making sets of higher lows, all right, lower highs and lower lows, we say that market is in a downtrend. So how do we know the market is in a downtrend? That question of how do we know the market is in a downtrend? To know that the market is in a downtrend, look for the highs and the low, their position, the positioning of the highs and the low. All right. In a downtrend, there will be a high. So it is in an uptrend. There will be a high. In a downtrend, there will be a low. So it is in an uptrend. There will also be a low. But the difference between the uptrend high and the uptrend low is that, or the downtrend low, is that in a downtrend, the lows are below the previous low. Therefore, the market is moving low. We have a low, okay? Another low is below it, so we call it a lower low. We have a high, okay? Another high is below. We call it a lower high, all right? So when the market is making sets of lower highs and sets of lower low, we say, in short, the market is in the downtrend, okay? That's how we know market is either in an uptrend or a downtrend. So if the market wants to reverse at this zone, the first sign of reversal will be something like this. Let me just draw this again. We have the market moving like this, okay? Moving like this. The first sign of reversal towards there will be something like this. It has broken its previous high. Take this for example. All these highs, the market has not broken its previous highs, respecting the order. You must be a successful forex trader. You must respect order. Forex works with pattern. It works with order. Even though you have 20 years experience in the financial market, the very day you become indisciplined, the very day you let emotion control your trading, you become a losing trader. It doesn't really matter how long you have been in the market. The very day you allow your emotions, the very day you allow the happenings around you to control your trading decision, to control, you are not following your strategy, you are not following your trading plan. Okay? You become a losing trader. You are not a profitable trader. Okay? So for example, now we have sets of, it follows pattern. We have a high, we have a lower high, we have another lower high again. We have a low, we have a lower low, downtrend. Now, we now have something odd happening around here. We say, okay, the market want to reverse, okay? And how do we know the market wants to reverse? The previous high was broken. Okay? The market now forms another high. You see, oh, something is happening. Previously, highs were low. Okay? And now, highs are getting high. Okay? Highs are getting high. Yes.
Higher than the previous high.
Yes, higher than the previous high. Then you now say, and a reversal. The reversal want to happen. And then we obviously see things like something like this happening. How do you know? Are you a prophet? How do you know? It's because you understand the language of the market. Alright? So it's towards this area you should be looking for bullish reversals. When you see something like this in the first place happen, you should be looking for bullish reversals. Because the market is obviously telling you he wants to turn to the upside. And then that's where we now have diagonal resistance, which are called trend lines, coming to play. Diagonal resistance coming to play. Okay.
The language of the market is the candlesticks.
Yeah.
Just want to trade one or two.
Yeah.
When you are looking for the higher highs and the lower highs,
Okay.
and we talked about the V bounce.
Yeah, V bounce. Yeah. This is where the V bounce is.
Yes. Would it be okay if you use the lines as a line style chart instead? Those kind of.
Well, you know, this is basically an illustration class. We'll get to where we'll look at the main thing, okay? We'll look at the chart, okay? So now let's just use this as an illustration. This is not what we are going to be seeing. I'm going to show you how the charts and all of that be. But I want to demystify. I want you to understand what is happening. So that when we see it in the live market, we'll be able to recognize it, okay? Just want to decloud everything. All right, so let's take, for example, this. Now, what are trend lines? We have been able to say support. We have talked about support and resistance. When the market gets to resistance, it turns down. When the market gets to support, it goes up. Okay. What are trend lines? Okay.
Please, I want to ask: is it possible?
Okay.
At this point, when we think the market has reversed,
Okay.
maybe it goes up, make a little higher high, go up again, and reverses and starts.
It's very possible. It happens. Okay. It's very, very possible. We could see something like this. Okay, but scalpers can actually make use of this little movement. All right. You can see something like this. It depends on your target. If you're targeting 10 pips, probably you'll have caught this. If you're targeting 100 pips, hey, you understand? You understand? So it depends on you. It depends on the kind of trader you are. Most times, if you are targeting 100 pips, you can turn and give you 100. But who do you think will be more profitable when we have these quick turns? The scalper, because even in the main turns, there are quick turns. There are still quick turns. All right, and all of that. So now we can have something like this. The market starts choking you, all right, and then eventually, start going in that direction again. In a much higher time frame, this was just a pullback, all right. This was a pullback. If you look, maybe if you were trading 1 minute and you see something like this happen, look at the 5 minutes. This was just a pullback. The original direction was down. This higher or whatever just formed as a pullback. The original direction was down. So let's quickly talk about trend lines. What are trend lines? Okay, trend lines are support and resistance. They are support and resistance, but they are not the normal support and resistance that are the roof and the floor. All right, but they are called diagonal support and resistance. We have horizontal support and resistance. This. Okay. That's where price move in between them. We can call this the resistance. We can call this the support. Price just moving in between them. Okay. Then we have diagonal support and resistance, where price still moves in between them. Okay. Price still moves in between them. But if you want to talk about trends, if you want to be a trend follower, in the financial market, you should be looking for trend lines. You should learn. I'm going to be teaching you how to learn how how to master the act of drawing trend lines. So you just simply need to do is connect two trend lines. All right. I told you the way to know that a particular place has significance, right? A particular place has significance is the market reaction to that particular region, right? The market gave you first turn, give you second turn, third one you enter, right? Now, okay, talking about the diagonal ones, because trend lines are support and resistance, only that they are diagonal support and resistance. Okay, they are support and resistance, quite all right, only that they are diagonal support and resistance. They are not the normal horizontal support and resistance that we know. Okay, so now having said that, you still do the same thing. For a trend line to prove itself to be a trend line, we need to see retest. We need to see market coming to that region and giving that region relevance. All right, and how does the market give the region relevance? It's by acting the same. All right, take this as very, very important. How market gives a particular line or region relevance is by acting the same along that region. All right, by acting the same along that region. So we could draw a trend line. We connect trend line by connect. That's if you want to draw an up trend line. That's an up trend line. Okay, we start from down here. We connect series of lows. Okay, we connect the first low to another low. Okay, and then we have something like this. So when we connect series of lows, we get a downward trend line. So we could say this is the first touch, this is the second. When the third happens, we look for V bounce, where the market pauses, and we enter here. It goes. Okay. Now, when it happens the fourth time, this place has already proven to you that it has relevance, right? That's proven that it has some level of relevance. When it comes here the fourth time, you do the same. You look for V bounce. Okay, or look for bullish candlestick patterns. All right. So because it has proven to be, this trend line has proven to be a support, a diagonal support. Let me write that out. A diagonal support, or a diagonal demand zone, or a diagonal seller area, or a diagonal floor. All right. So let's come to, we are still talking about trend lines. Okay. Let's be talking about trend line. We see they are diagonal support and resistance. Now let's talk about diagonal resistance. When we have something like this, we connect two. All right. We don't know that the third one is going to happen. But along this area where we connected our two, along the area when we're talking of support and resistance, we're not talking of one line. Along this area, okay, where we connected our two, we see the market pausing. All right. That pausing along, wow, it was going with full impulsive, with strength. All right. Full magnitude, and when it gets here, it starts to pause. We'll look for a V bounce. Sorry, an N bounce, right? An N bounce. And once we get an N bounce, we enter short. That's we enter for a directional move. All right? Because why did we take our trade here, not here, not here? It's because before this, we have not known which one is the resistance, which one is the support. We have not known how the market wants to go. But because we have seen a high, we see a high that is lower than the third LH. That's the third lower high. We took an action to sell. All right? And we could make a lot of money. All right? We make a lot of money doing that.
The scalper can be buying and selling in a particular trend.
Yes, obviously. On a much bigger trend, for 1 hour to happen, we have series of uptrends and downtrends. For 4 hours to happen, we have series of, on the lower time frame, like 1 minute. For an uptrend to be happening, or for a bullish, only one candle, let's talk about, for one bullish candle to form in the 4 hours, we have series of uptrends and downtrends. For just one bullish candle to form on the 4 hours.
And that one candle contains so many
impulsive moves and
pullbacks.
Yes.
That a scalper can enter
and
take profit,
take out, and
then when it's
about targets
pull
back, he enters again, and all of that. Yeah. So now see, for example, how we could draw trend line works in all time frame. All right, it works in all time frame. So for us, you are able to prove, and there's no right way of drawing a trend line. Anybody that tells you there's the right way of drawing a trend line is lying. Just take the zone. Take the zone. How do we take the zone? Connect. When you want to draw a down trend line, you connect highs, lower highs, lower highs. Connect the lower highs. All right, connect the lower highs. Once you are able to connect the lower highs of that market, you have been able to connect at least two, at least 1, 2, 1, 2, at least 2. Market has showed you that this potential line can be a reversal. All right, it can be a resistance, a diagonal resistance in this case. So what do you look for when the market gets to this same zone? Is an end bounce, or you look for bearish reversal pattern. So we can describe a downtrend as price making sets of lower highs, highs that are lower than another. So that's basically what a trend line is. All right, let's talk about the last thing we have to talk about today so that we could go. All right, still talking about types of trend, let me just clear something. We have 2 types of trend, but when talking about market movement, all right, we have only three ways the market can move. 3 ways the market can move. The market can either be, if you're going in an uptrend, this is what it's doing. This is what it's basically doing. Uptrend, all right. This is what the market is doing. If it's moving in an uptrend, it's moving something like this. Okay, this is how it moves in an uptrend. If the market is moving in a downtrend, this is what it is doing. Okay, and then we have what is called sideways movement. All right, sideways movement. The thing that kills a lot of people in the financial market is that the market is not trendy. They are looking for horizontal support and resistance. Very wrong. All right, if you see a market that is not trendy, don't look for horizontal support and resistance, because they are meant to be broken. You understand? If you are looking for horizontal support and resistance in a trendy market, you are killing yourself, because those horizontal, you know, when I say horizontal support and resistance, you know what I mean? I mean the market is going to break. The aim of a horizontal trend line in an uptrend is for a market to break it. So don't ever think when the market is getting here again, you go and sell. You would lose your money. All right. So what we hope to see when the market wants to make an uptrend is break and retest. Break and retest. I will tell you the last principle of trends. All right. The last principle of trend, which is when a trend is broken, when a roof, all right, or a resistance is broken, it becomes a support. When a support is broken, it becomes a resistance. I will explain that. But now we have 3 basic ways the market moves. 3 basic ways the market moves. Either when it's moving in an uptrend, we are talking of upward movement. Okay? If it's moving in a downtrend, we are talking of downward movement. Then we have sideways movement. Okay? Sideways movement. This is where your horizontal support and resistance will work, because the market will be in a box. We call this ranging. Another name for sideways movement is called ranging market, or whatever you call it. All right, ranging market or consolidation. All right, so you see market move. First of all, to make this a resistance in the first place, price has to prove that what is a resistance by coming here at least 2 times. Okay, it has proven that it's a resistance. The 3rd time, when the market comes to this place, you start looking for pauses and you take your end bounce. Right now, it has proven that yes, it's support, because it has done it at least 1. Okay, it has done it at least 1, 2. Then the third and upward, you start looking for an end bounce. Sorry, for a V bounce rather, right? A V bounce. Okay, so this is how the market moves sideways. Market is moving sideways. So we have 3 ways the market moves: uptrend, downtrend, sideways movement. We call this ranging between 2 prices. When I say something is ranging between 2 things, it is moving in between 2 prices. Let's say this is 1. Okay, 2, 3, 4, 5, 6. The market is ranging between 1 and 6. It's moving in between 1 and 6. So we call it a ranging market. If the market is moving like this, we call it a trending market. All right. So these two are called trendy. So we basically have trendy market. So we basically, if you are saying how many types of market we have two kinds of market. We have the trendy market and the sideways or the ranging market. Now, components of the sideways movement components of the trendy market, we cannot divide them into two. A trendy market is made up of two kinds of movement: uptrend or downtrend. Uptrend or downtrend. So that's what we have. So now let's look at this. Let's talk about when a support is broken. It turns into a resistance. Okay. The last law we do not talk about support and resistance. The last law we do not talk about support and resistance is this. Let's say we have this, okay, to be a range, and then we have price moving in between it. Okay. How we know that the range is over? Because the market cannot range forever. The market cannot range forever. It's not forex. If the market is ranging forever, it cannot range forever. So now, how we know the market is off a range is when we have a breakout. Okay, we have a breakout and we have this, a pullback, and then we have this. Okay, this is a breakout. So components of a breakout: the market went up, broke previous reversal zones, and then pull back to those previous reversal zones, and you start seeing bullish patterns. All right, that means the market wants to go up. Okay, so we say the market has broken out of a range and it start moving in a particular direction. So whenever a support is broken, it becomes a resistance. Okay, a resistance. Then whenever a support rather is broken. Okay, sorry, we made a very big mistake.
No, it's the same thing.
But I just want to explain it the way it is.
It's either way.
It's either way anyway. But for example, let me this we just said here is talking about this. When this is broken, this, okay, it becomes a resistance. Then when a resistance, that's this scenario, okay, when a resistance, all right, is broken, it becomes what? A support. Okay, it becomes a support. When a resistance is broken, it becomes a support. When a support, that's this down one, let's say the market went like this and broke this zone, it retests and then goes down. So whenever a support, we have arrow, resistance, we have support. Whenever a support is broken, it becomes a resistance. And this law of whenever a support is broken, it becomes a resistance happens mostly in trendy market. That's the law of whenever a support is broken, it becomes a resistance, or the law of whenever a resistance is broken, it becomes a support. It happens mostly in trendy market. Let me prove that to you. Okay, this is a trending market, right? This could be because it's a turning point. Support and resistance are basically turning points. All right. Now this high was broken. It became this resistance, because if the market had turned, it would have been a resistance. All right. It was broken. It now becomes a support here. This roof was broken. It becomes a floor. This roof was broken. It becomes a floor. So it happens in trending market. Okay. So market moves by breaking and retesting. Yes, no, it doesn't happen in sideways market. It only happens when a sideways market wants to change into a trend, like how we're talking about this. All right. The only time it happens in sideways market is when the market wants to break and continue in a particular trend. The consolidation is over. All right. It wants to take a direction.
So a sideways market can also be called a consolidation.
Yes, can also be called consolidation. Yeah, the market is consolidating between two prices. All right, the market is moving between two prices. Right, it's not giving you a direction. And then we have a directional market. The market moves by breaking a roof turning into a floor. Breaking a roof, turning into a floor. Breaking a roof, turning into a floor. All right? Because when we have a story building, you may think you are in the roof of that story building. You may be in the, for you, this may be the roof, for example. Okay? But to some other person above you, it's a floor. All right? For somebody above that person, above the person, it's a floor. So now we have this as a roof for us. The market broke the roof and came back and retested this as a floor. Because where it is, the region the market has entered is seeing this place now as a floor. It broke here. The place it was seen as a roof now is now a floor. Don't even understand. That's how the market moves. So that's the law of when a resistance is broken, it becomes a support. When a support is broken, it becomes a resistance. All right? That's what we have. Okay. Another last thing I would like to tell you, let's just talk about breakout as quick as possible. Breakouts. Breakout. When they say something broke out, okay, when they say the market broke out, it's telling you that a particular candle closed 30% of a particular candle, 30 to 40% closed outside a resistance or a support, or outside a high. Okay? When they say the market broke out, it's telling you that 30 to 40% of a particular candle closed above a level. So if we have something like this, for example, something like this, the breakout of this is going to be when a candle, all right, a particular candle, let's say this is the whole candle, close, this is like 50% of the candle, a particular candle closing above this zone. So we call it a breakout. All right, don't confuse a breakout for fake out. Let's not talk about fake out now, but there are lots of fake out. There are times that, yes, when 30 to 40% of a particular candle close above a zone we are looking at, we call that a breakout. It's a valid breakout. So when we see something like this, just 10% close, that's not a breakout. But when 30 to 40% of a particular candle is outside a particular zone, we call that a breakout. Okay? That can be an entry point. All right? That can be an entry point. Based on, they have two ways. We have aggressive entry, and then we have less aggressive entries. There are times that you don't even wait for it to enter. Most times you are correct. Most times you are not. All right? So you are both right. So now, what are we talking about breakout? When 30 to 40% of a particular candle or of a particular pattern is outside a particular zone, we call that a breakout. Remember, just take note of what I'm saying. When 30 to 40% of a particular candle or a particular pattern is outside its previous zone or where we are looking at for the market to break out, we call that a breakout. So we'll be talking about the London break strategy. All right, let's talk about one strategy. When we talk about the London break strategy, okay, the London break strategy, this is how it works. When we have, let's say you have a particular candle, all right, we have a particular candle, for example, and then we measure 3 pips. This is 3 pips out of this candle. So this is 3 pips. Okay, we have another 3 pips, okay, of this candle. All right, and then we see price moving like this, and let's say this is our 3 pips out, and it does something like this. Is this a valid break? Why is it not a valid break? Because because the close of the candle is less than 30% of the candle. But if we have something like this, is this a valid break? Yes, it's a valid break. Go about 60% is already outside what we are looking at. So this is a valid breakout. So when we are doing the breakout strategy, we can place a trade here for a buy. Okay, we can place a trade. If it happened under here, place a trade for yourself. And one thing you should take note of, one thing that kills a lot of people in Forex, it killed me sometime even recently, is that they don't wait for a candle to close. If you are looking at 4 hours candle, wait for that candle to close. You may feel that the candle is going to react to this zone. What is affecting me this week, basically, is that I not wait for the candle to close. I was too confident. I say, oh, this thing is going to reverse here. I'll be professor after all. See? But the market told me that, you know, he's still the boss. You understand? The market always tells you that he's the boss. You understand? You are his boy. Puts you in his place. Alright? That's how it works, basically. Anytime a successful trader start having characteristics of an unsuccessful trader, maybe because he has a distraction or the rest, that very time, go to heaven or hell, that person is not a successful trader. Is at that period, that maybe from January to February, or maybe from December to March, the person start having distraction. Maybe he has some problems, some crisis, and all of that, and it's affecting his trading. From December to February, that person was not a profitable trader. He was not a successful trader, even though he has been a successful trader for 20 years. That's why we don't have to let emotions come into our trading. When we talked about characteristics of a successful trader, we talked about emotion, talked about greed. When you're not following your trading plan, very, very important. If you don't follow your trading plan, you're not following the plan. You are not a successful trader. You have the characteristics of an unsuccessful trader. So this is breakout for you, okay? When a candle closes 30% outside of a zone we are looking at, that's a valid breakout. So we can enter for a buy or sell position. All right? And take note, the last thing I want you to take from this class, the very, very last, don't enter a trade when the candle have not closed. If you are looking at a trade in a 1 minute time frame, for example, okay, 1 minute time frame, enter only when the candle have closed. Let's say this is 1 minute time frame. Every 1 minute, that means the candle is closing and another candle is opening. If you say 1 hour time frame, every 1 hour the candle is closing and another candle is opening. So if you are trading a 1 minute candle and we are 130, so we are 30, we are like 130. At 131, that's when you should be looking for another opportunity. For example, now this invalid break. All right, this is a fake out. All right, it happened at 131 and closed. This is 131. When this other valid break happened and closed at 132, this is 131 because this is a 1 minute. That means each of these candles represents 1 minute. Okay, each of these candles represents 1 minute. At 132, when this one closes, only at 132, even though your village people make these candles to still be moving at 132, place the trade because this is where it's supposed to close. Okay, I don't even understand. At exactly 132, by right it's supposed to close because it is 1 minute candle. That means each of these candles represent 1 minute. So here, for example, now the fake out closed at 131, 1 minute. 1 minute later, we had the candle that was doing up and then closed. As soon as 132 just reached, that whatever was 131 changed to 132. Place your trade. Whether this one you still see it moving or whatever. If it's 1 hour candle, let's say this is 1 o'clock. This was 1 hour candle. This is 1 o'clock. Exactly 2 o'clock. Place your trade for this one. So far as it matches your breakout criteria, place your trade here. As soon as it closes, as soon as it matches your breakout criteria. All right. So that is what we have for today. Thank you very much.
We go long. It's
Yes.
bullish trend.
Yes, and all of that. Yeah.